April is in the books. May is here. One of the best months for the stock market since COVID. V-shaped recovery, rally to all-time highs. I want to talk about the risks that are now in front of our face here. This is the point in the rally where I start to get a little more risk aware, a little more concerned about the ground that we've covered. The timing here is super important. I want to walk you through exactly the warning signs. There's 4 of them that I'm paying attention to right now, and I want to show you the portfolio updates that I've made this week. So let's get into it. Hope you had a good week out there. Let's jump in. So this is what the Qs looks like now. This is a weekly chart, and this is the beautiful V-shape 1, 2, 3, 4, and 5 weeks higher in a row. Certainly not unprecedented. We've had 5-week streaks before, but as we start to get more than 5 weeks up in a row, you're getting just that consecutive band that's getting stretched just a little bit. But here we are. Let the good times roll. We had a big earnings week. We'll talk more about that a little bit later. So here is the first warning sign that's just kind of flashing here in front of our face, and it's crude oil. Now I've got a chart of futures open. This is the front contract, or it's the June contract of WTI. And you can see that, when this rally started, we were, really kind of in this $90, 80s area for crude oil. And as this rally has continued in stocks, so has the rally in crude oil. Effectively, we've gone right back up to the highs. And so, yes, we did sell off. We pulled off the highs on Friday. We're still above $100, and we're still comfortably sitting up in this range while stocks are continuing to push up. So this conflict in the Middle East, while is still pretty much at a stalemate, right? So we're still not seeing the straight open and things flowing again. Truflation. So you can look at CPI, you can look at truflation, whatever you want to look at. We are going to have to expect that inflation is going to be stickier here and potentially still on the rise. Everything has a bit of a lagging effect here as it works its way through the economy, but we are still looking at $4 average gas at the pump. We're still looking at $4 or $5 heating oil. It's expensive out there, and the longer that crude oil stays up here, the more we have this, hangover effect here for the market. Warning number 2, these kind of go hand in hand, but this is 10-year Treasury yields. So you can see that this week we are moving back up towards the highs from prior to the stock market rally. So again, stocks are rallying and rates are inching higher here. So this is another warning sign where we're back up to 4.4. And if we start clearing above the March highs here, then, look out above type of thing. Warning number 3, 52-week highs. Now, a few weeks ago, when this rally was getting started, I dismissed this as being a concern. I said, there's lots of folks when we were in week 1 or 2 of this rebound that were looking, very intently here at 52-week highs, saying, hey, it's not moving. And I said, you know what? Not a problem yet. Let's see if it starts to expand as this rally matures. We still aren't seeing much of an expansion. Now, this is Thursday's data, so I do need to see what Friday looks like. But 150 stocks hitting 52-week highs across the NYSE, it's just not that impressive. It's fine. Like, there's a little bit of strength there, but it's what you'd expect on just a much more meager kind of rally or strength underneath the hood. Warning sign number 4. Sentiment is a fickle thing, but this is the Q's stream on StockTwits. And you can see that the sentiment here is inching towards the bullish side again. So a ranking of 72 out of 100. Notice a week ago, the bulls were at about a 58%. So this is looking at the percentage of like bullish or bearish messages being sent or shared on StockTwits social network. A month ago, which makes sense, we were at 41. So straight, just, kind of in the bearish camp here. So what we're basically illustrating here is as we start to inch higher here, as the market extends itself, people are getting more comfortable. They're getting more, eager to put capital in. They're starting to get some wins again. And so this, coupled with maybe the put to call ratio here for warning sign number 4, which is just kind of hanging out down here in the lower bands, these are all things collectively now that are kind of just flashing, right? Now, what are we going to do about it? So before we talk about some of the adjustments here, I want to talk about, again, the timing behind this, because I am a trader first and foremost. And so when I start to get concerned, or when you start to put capital back into the market, that timing matters as much as sort of the evidence that you're looking at. So again, we flipped bullish here April 9th. That was 16 days ago. Started to inch more capital 2 days earlier before that, when we went into our yellow mixed warning, kind of mixed state in our market environment scoring. So we have been in this market here, and it seemed crazy to want to come in here. And I saw the messages. I got email from subscribers. Hey, you sure about, increasing exposure here? And it's like, no, we're never sure, but the probabilities and the framework that we've built out modeling the market suggests that that's the time to start to increase exposure. And so, you kind of get looked at with multiple, like you have multiple heads at this point, but now we're up here, and I won't say we're mature, but we have covered some ground in the past, call it 3.5 weeks. So here's what I started to do this week in my sort of tactical active portfolio. Don't look at the exact percentages. This was literally 2 minutes before I hit record. I had AI just make me a quick graph here so I could spend a second on this topic. So don't worry about the exact percentages, but the adjustments that I started to make this week was to pare down a little bit of the risk exposure that I have across quant rocket stocks, across just core holdings that I have, anything I'm managing sort of actively. Start to bring that exposure down just a little bit. And I started to add some energy, just straight up energy, XLE, into the portfolio. Now you could look at materials, you could look at, defense, you could look at a handful of other things that would fit in this kind of bucket. But I think energy is just the most pure. Obviously, go back to slide 1, look at crude oil, look at the conflict for all the reasons that are pretty obvious here. This also helps, right? This is correlation between XLE and the NASDAQ 100. And so what we're looking at here is the Qs is the red line. The green line is XLE, is energy, right? So you can see that they've basically been, mirrors, inverse. They're kind of just going in opposite directions. They both peaked and turned, basically on a dime here at the end of March into April. So Qs found a bottom, obviously, and here's the big rally we're enjoying. And then XLE topped out around that time. It's been heading lower. The correlation here over the past year or year to date is negative 0.29. So you can see they're moving in opposites. Not super strong, but it's still a pretty reasonable, kind of inverse hedge to a risk book, right? You could buy insurance, you could buy puts, you could raise cash, you could buy bonds, you could do all kinds of stuff. This is what I decided to do, was to start to add some XLE exposure into the portfolio. And it's not willy-nilly, it's because I have actual signals behind it. If we look at XLE here, you can see this is our smart trend filter. We talk about it every week, or show the kind of sector scoreboard. And so this week we finally printed green dots again, which basically tells us that, hey, the uptrend is back intact, right? Like the parties on the bulls are back in control here on the daily time frame. So this signal is what allows me to now get exposure, because I have a rules-based process to effectively manage the exposure I have in energy now. And this sort of correlation analysis says, hey, this thing that I'm adding to all these other risk assets should hopefully zig while the other zags. So for me, when we look at all 4 of these warning signs that we just went through, I want to make it very clear. I'm not a bear on this market. Like, I am not shorting the market. I still have plenty of risk exposure. This might not be exactly the ratio that I have, but I still have plenty of risk exposure through quant rockets, through all the things that I, want from the mostly AI CapEx build out. I've just now sort of augmented that with some, hopefully, protection if things get worse or escalate across the Middle East. So that is what I'm paying attention to in terms of risk factors. And I think you could classify me as just a risk aware bull. I was pretty, pounding the table on just being outright bullish over the last few weeks, saying just, bullish. It's time to be bullish. This is not the market environment we had a month ago. And now I am still of the belief we are in a bullish backdrop, but I'm aware that the longer crude and rates and all these other things stay elevated, the more sort of dicey the floor looks if we start to, trade lower type of thing. All right, let's hit the numbers real quick. Oil was up 8% this week. Qs were up 1.5%. Those are your big standouts. Gold was down 2%. Mag 7. So we had a lot of earnings reports. I'm not going to go through all the individual reports. I'm sure there's a million, news sites that you can get the numbers. Generally speaking here, you can see that the market really did favor Google. Tesla did not report today. I'm just showing the Mag 7. And you can see Meta and NVDA. NVIDIA didn't report either. But those were the two underperformers this week. I think, again, you still have question marks around Meta and the spending and the RO, return on capital on all of that. And Google now is just looking as though it can do absolutely nothing wrong. It is the best stock in the universe. And everybody is, really going for Google stock at this point. S&P 500 up and to the right for pretty much all the week. Volatility at the cheapest we've seen now, going all the way back almost year to date, but since February, you can see we're in the 16s or 17. I don't have the exact figure, but 16.71. So nice and cheap to buy some insurance for your portfolio. Dollar index rolled over a bit this week, and crude and 10-year Treasury yields, you can see, were pretty bid, back up around 4.4 like we talked about. Sectors on the week, energy was the standout to the upside. So was real estate, materials, discretionary. Those were the hardest hit. So this is our smart trend filters, what we talked about on the energy signal. You can see here's the energy signal right now that flipped up basically after its a month pullback. I was hoping to actually, I posted charts on energy when we were dipping down here, and I was sort of excited about the dip. I was hoping it would stay down there longer and just, allow me to get back in at a cheaper price. But here we are, had to pay up more than I wanted to, but ultimately finally got the proof to get back in. And there's lots of stocks kind of in the middle here, mostly all still bullish. Healthcare is still negative for us, but that's pretty much it. Bitcoin, this one's been a little choppy here for us. So a lot of our signal, our internal models on Bitcoin, they did get sort of whipsawed this week. We did get some exit signals. I still have tactical exposure in it, but, really just looking for this breakout right here. So we sort of formed this new resistance here. I've been talking about 75 to 77. Looking more like it's 77 to 78, so like that's the ceiling. We really need to kind of get ourselves above. And again, I still believe that if we can kind of launch through this zone, we do have a fast move up into the 90s. It's a bit of a volume pocket, air pocket, I think, above this level. So next week, we've got the jobs report, which will be important for markets to chew on. So let's pay attention to that. That'll be on Friday. And we're going to jump into some charts now. Our sponsor of this episode, though, is Investors Business Daily. Check out those links in the description of the show. Tell them Evan sent you. Get some discounts. Market Surge, IBD Digital, two great products. Check out the description once you get done. Let's get into some charts. All right, we've got some charts in front of us. Let's get into it here. This is the S&P 500 cash settled weekly market. 5 weeks up in a row. So this 69.50 area, I think that's still the big elephant in the room. If you are a manager of risk from a more intermediate, longer term perspective, hell, even short term perspective, this is the area I want to see the S&P 500 hold above, sort of full stop, right? So that really hasn't changed. If we go down to a daily time frame, You can see that we did do a little pitter patter here and kind of digested through time, but still sort of grinded higher. We are obviously in the midst of earnings season. We did reject a bit off of the highs of the day on Friday, but still feels pretty meaningless at this point. Overall trend is higher. We're stretched on lots of different metrics, not so much on the S&P 500 per se, but individual stocks, of course, the things that are actually working are working really hard, right? Like that's the way to frame and think about this market. It's not a broad-based rally. It is a fairly concentrated rally. And those concentrated stocks and segments of the market, they're doing a lot of heavy lifting. They are the ones that are stretched. QQQ, you can see pushing up to highs here, closing strongly. Again, much less of a bitter patter here, just kind of grinding higher, V-shape, full-on chase, squeeze, whatever you want to call it. This is explosive here. So this is certainly, just heated on lots of different metrics. Russell 2000, a lot more reasonable, a lot more kind of technically sound here from a structural perspective. You've got a base, you're starting to lift out of it. You closed at new highs on Friday. This actually looks good. This looks welcoming. This would be a breath of fresh air if we start to see the rally broaden out and Russell 2000 start to pick up the lead a little bit. More stocks hitting the 52-week highs list, getting oil prices to come down, interest rates to cool off or at least go sideways. These would all be things that would be very welcoming and would start to, kind of wash away all of those warning signs that we're currently looking at. So let's talk about some other segments here. We mentioned the VIX at the top of the video, almost year-to-date lows. I mean, not quite that low. January started off pretty low, but certainly in the bottom 10 percentile. So pretty attractive spot to put on some fairly cheap hedges if you want to protect a portfolio, especially if you are involved in this market and you are starting to get uncomfortable as we go 5 weeks up in a row and a little more stretched. This is certainly a spot where it's a lot cheaper to hedge a portfolio now than it was a month ago. If we take a look here at crude oil, which we already did, but the USO ETF, you can see kind of hammered out this Friday session, still down 3%, still off of highs, but, still just got a pretty sturdy uptrend behind it as we look at it now anyway. XLE, so again, this is where I picked some up this week. Chart looks pretty good. Had a decent pullback here. I mean, this was a 16% correction and a very quick kind of rebound here, 10% off the lows. So we're kind of just sitting in the middle of this range now. I don't know what level this was that I was keying off of, but you kind of have this as your goalpost and you're really just kind of sitting in the middle. So, I mean, you can make a case either way that, even if it checked back a little bit and consolidated, looking for a higher low against 54, or you're certainly looking for 54 to hold. I still think XLE, for all the reasons we discussed earlier, look at the monthly chart. I mean, this thing really hasn't gone too far in a long period of time. Again, the one thing with especially XLE is it pays dividend. This is not necessarily a total return look here when you start to look multi-year view with TC2000. So just keep that in mind. But generally speaking here, I like it. I own it. Again, kind of using this as a little bit of a proxy hedge for risk. I'm not bearish on the market. I'm just looking to diversify into something that I think would protect me in the event that things escalate overseas. Materials would be a decent spot as well. These are both kind of scarcity type, rare beneficiaries of sort of conflict where the flow of commerce starts to slow down and trade starts to slow down. So materials here could be an interesting one as well. Yeah, I think that's all I need to say. SMH, let's touch on that real quick. So this led the charge. This was the first to get to all-time highs. This broke records on April's performance. This week, it was mostly a digestion week, which was good. I think if you just went vertical here and had another 10% week up, you would very much be getting into blow-off top territory. I mean, you still could be getting into blow-off top territory, but at least we sort of, pulled a little bit of that momentum out on Monday, and then we sort of just coasted higher throughout the week. So semis took a little bit of a breather here, but this is the concentrated area of the market that is dragging everything else up. IGV. So I did a video throughout the week, intra-week, On software, some of the names that were hitting our momentum model in software land, IGV here started to, pick itself back up and get a second breath of energy, burst of energy here on Friday. So that was nice to see. Closed the week up 1.68%. Not bad, right? Like, I mean, again, I don't love the basket per se, IGV. I don't own it. I do own some individual stocks within it, but it's trying to at least find a little bit of a base here. And I think that's interesting. We'll look at some of those stocks in just a moment. Other thing I wanted to mention, and then we'll look at the Mag 7 real quick. Here's MAGS, MAGS. This is an ETF that tracks the Magnificent Seven. It hasn't broken out. This is actually an underperformer, really, when you think about it in terms of any of the other major indices. This still has not broken out. So I think that's notable. I think it's something we want to pay attention to. It tried to get a push here on Friday, but then it sort of tapered off again. So let's see how this progresses. Let's see if it can make a new high here. But Mag 7 showing a little bit of relative weakness. Some of the individual names. NVIDIA. So they didn't report earnings. I will say the action this week was pretty terrible. So bearish engulfing as it attempted to make highs. So you essentially had a quick check up at all-time highs, a very quick reversal, and then you bearishly engulfed the prior week. It's not exactly what you want to see. Again, chart overall hasn't broken any trend by any means, right? So, but in the short term, that's not great action. It is still a very clear underperformer relative to SMH over the past year. Apple, very similar here, kind of poked its head up, didn't quite make highs, reported earnings on Thursday, had good numbers, up 3%, still great performance, but sort of checked back a little bit. Meta is still trying to collect itself and find itself and consolidate and go through transitions here, so it's just still in a messy range, getting kind of punished by the market. Tesla did not report this week. This was last week, but it did perk itself up. Daily chart looks exceptionally well. I do have a position here. This is probably the best bottom fishing I did in April. It was right before I went on StockTwit's interview and talked about it. 342 was my entry. Sometimes you get lucky. So I still have those shares. So Tesla looking pretty good. Hopefully this is a higher low. Hopefully we can leg back up. But for now, I am long. Amazon, really no air above, it's only air above it, right? So there's no resistance above it. It is stretched 5 weeks up in a row and a cool 33%. But earnings are out. It should act well from here. We'll see if it can. And Google, everybody loves Google, right? This has been such a just love-hate stock. Hated, a month ago, loved again, hated earlier when AI was starting to make its way through. And here we are. So Google, everybody wants it. And, it's just a chase at this point if you want to pay up for it. All right, let's look at some of our stocks. We'll leave you with some signals here, and then we'll call it a Friday. So here's our dashboard. It's our members dashboard. So S&P Friday up 0.28, Galahad portfolio up 0.5%, Quant Rockets 2% up. We hit a lot of targets this week. 7 targets. We did prune the list. We had some exits here, some names that just flat out were not working from a momentum standpoint. So that was nice to see those names kind of coming down. And it was just generally a reduction of names on the list and profit targets being hit, which was good. Galahad on the last 5 days up 2%, S&P up 2%, basically an even race. Not too much to say about that one. Let's take a look at our market environment here. So again, this is what I showed earlier. This is our market environment sort of health score. And so this is what guides the capital that I want to have in the market. When things are excellent, then I generally speaking want to be fully invested, unless I have warning signs, divergences, risks, catalysts ahead of us, earnings, things like that. But generally speaking, this is the environment where I want to be swing, positive type of thing. And so here we are. I mean, that's just it for another day, 17 days, and that hasn't changed. Breadth, participation underneath the hood, decent. It's not strong, but it's not warning or it's not bearish by any means. Let's take a look at some individual stocks, and then we'll call it a day. So LITE, I got to just show this one off. I mean, this has been a huge winner for us in at 406 in February, and it hasn't been clean. I mean, there's been plenty of 10% pullbacks. I think this is, again, I'll keep it short because I don't want this video to go even longer, but as a trader, you do have to give these stocks some room. This is what our algorithm is good at, is giving things room when they need to breathe a little bit. I think lots of folks tighten up their stop loss so tight, it goes down 2 days and they're out, and then, a week later it's higher. So, this was one that required plenty of patience. I'm showing it here today because it's just breaking out again of another continuation pattern. I have no idea if it'll continue. We've hit all our targets, but it's acting well. USAR. So this one here, take a zoom out. This is kind of that rare earth, precious metal sort of play here, but it's got some momentum. Take a look at the volume down here. We are in at 1962. Our stop, their exit is currently above our entry, but we're looking for higher prices. Modine, I've talked about this one as before. It's been on the list before. Fresh breakout here, Thursday, Friday. So you can see kind of a breakout and then follow through. Looks good. We are in. DDOG. So this was a video I did on Tuesday or Wednesday of this week, 3 software names highlighting them. DDOG was one. And so this is one where I think when I posted the video, it was closer to our entry in here. And this is, something that's just acting a little bit better than IGV basically. And it's a software stock that we have a buy signal on. So that was, sort of interesting. Duolingo, talked about this one in the video here. This was absolutely crushed. Look at this stock from June of last year, down 80 some odd %, left for dead. Looks terrible, but maybe they oversold it a little too much and we can catch a little bit of a retracement. Got in here at $100. Didn't get to our first target, but it's acting well. Rubric, same thing. Still hasn't really jumped, but this is a software name that is on our buy list that we talked about in our intra-week video. And I figured I'd show, excuse me, I would show NXT because this is the one that we talked about last week. Hasn't done anything. It's still just sitting here. Again, this is what we talked about earlier about giving stocks room and time. So maybe it just needs a little more time. Maybe frustrating, but we're still in it. We're down on it. Our exit price is here and our target's up there. So that's it. That's kind of the roundup there. Plenty of names that are still kind of showing up here. I thought the software names were interesting because they were finally a segment of the market that isn't just electronics, electronic components, AI stuff. And so there's, some signals that are creeping in other spots. But my portfolio at this point is now just like, AI related things and now kind of creeping into some energy stuff. Again, I don't want to sound it like I'm like a energy massive bull here. I just, again, think it's an appropriate way to, kind of hedge a portfolio or have some, again, orthogonal sort of positions. So that's it. That's what I got. Long video. Thanks so much for tuning in. We've got links in the description of this show to our IBD sponsor, to our trading system, Galahad, to our trading system, Quant Rockets. Thanks so much for tuning in. We'll see you back here next Friday. Take care.